Imagine this. Tesla stock is trading at $440 today. Most investors look at that price and think, I wish I could buy in lower, but I don't want to miss the upside if it keeps climbing. What if I told you there's a strategy where you could either get paid $1,000 in cash for simply waiting or end up owning Tesla shares at a discounted price of $380, a full $60 cheaper than today's market price? Sounds like magic, but it's a very real, very practical way to use options. It's called selling a put option. And if you understand how it works, you can turn market volatility into income or a bargain entry point. Let's break it down step by step. Tesla is currently trading at $440. You believe Tesla is a long-term winner, but you'd love to own it at a lower price. Instead of just waiting and hoping, you can sell a put option with a strike price of $380 that expires in 25 days. When you sell a put, you're making a deal with another trader. You're promising that if Tesla falls below $380 before the expiration date, you'll buy 100 shares at $380 each. In exchange for taking on that obligation, you receive a premium upfront. In this case, the market might pay you roughly $10 per share, which equals $1,000 total because one options contract covers 100 shares. That $1,000 is credited to your account immediately. You keep it no matter what happens next. Here's what makes this so powerful. From the moment you sell that put, there are only two possible outcomes, and both can work in your favor if you're bullish on Tesla. Outcome 1. Tesla stays above $380 all the way until expiration. Maybe it holds steady at $440. Maybe it rallies higher. Maybe it fluctuates but never drops below the strike price. If that happens, the put option expires worthless. You are never required to buy any shares, and the $1,000 premium is yours to keep. Think about that for a second. You agreed to buy Tesla at $380. If it fell, it didn't, and you still collected $1,000 for being willing. That's a cash yield in just 25 days on the capital you set aside, roughly $38,000 of buying power, without ever owning the stock. It's like getting paid to place a standing limit order. Outcome 2. Tesla dips below $380 before expiration. Let's say a market scare pushes the stock down to $370 or $360. Because you sold the put, you will be assigned and required to buy 100 shares at $380 each. At first that might sound risky, but remember, this was the deal you wanted. You were willing to own Tesla at a discount, and now you get it. Better yet, the $1,000 premium you already collected effectively lowers your cost basis to $370 per share. Instead of chasing Tesla at $440 like everyone else, you've bought it 16% cheaper than the current market price. Either way, you win if your long-term thesis on Tesla is correct. If you're never assigned, you keep the premium. If you are assigned, you own a stock you wanted at a lower price. That's the beauty of cash-secured put selling. It's a strategy that lets patient investors collect income while waiting for the right entry. But why even bother with Tesla? Why commit to buying at $380? Because Tesla's growth story is far from over, and many analysts believe today's prices will look cheap 5 years from now. Consider the major catalysts already in motion. Tesla is preparing to launch its robo-taxi platform, which could transform the transportation industry. Imagine millions of self-driving Teslas generating revenue around the clock without a human driver. This isn't science fiction. Tesla's full self-driving software, now on version 14, continues to improve at a rapid pace. Every update brings the company closer to fully autonomous vehicles. A successful robo-taxi rollout could create an entirely new profit stream worth tens of billions annually. Tesla is also making huge strides in battery technology and energy storage, expanding beyond cars into massive energy solutions for homes, businesses, and utilities. Its megapack products are already being deployed in large-scale energy projects across the globe, and demand for renewable storage is only accelerating. This energy business gives Tesla a second growth engine separate from vehicle sales, and it carries higher margins than many analysts once expected. Then there's the next-generation low-cost Tesla model, which aims to bring electric vehicles to a much broader market. Tesla's new unboxed manufacturing method promises to cut production costs dramatically, allowing the company to scale faster while protecting margins. Combine that with Tesla's plans for artificial intelligence hardware, Dojo supercomputers, and possible licensing of its self-driving technology to other automakers, and you start to see why long-term bulls envision a multi-trillion-dollar valuation. Some Wall Street price targets already reflect this potential. Analysts have issued near-term targets of $548 per share, while the most optimistic 5-year forecasts see Tesla rising to $2,000 or more if robotaxis and energy scale as projected. Owning Tesla at an effective cost of $370 after your option premium puts you in a position to capture enormous upside if those predictions materialize. Of course, selling a put isn't free money. There are risks you must respect. If Tesla suffers a major shock, say a market crash or an unforeseen company setback, and the stock plunges far below $380, you're still required to buy at $380. Your paper loss would reflect the difference between the strike price and the current market price, minus the premium you collected. That's why it's critical to sell puts only on stocks you genuinely want to own for years, not just trade for quick income. You also need sufficient cash or margin in your brokerage account to cover the potential purchase of 100 shares, which in this example is about $38,000. Risk management is key. Many investors set aside the full amount of cash to cover the purchase, known as a cash-secured put, to avoid leverage and margin calls. If you follow that approach and Tesla stays strong, you simply earn the premium. If it dips and you're assigned, you buy the stock at the agreed price, comfortable in the knowledge that you planned for this outcome from the start. Now imagine Tesla 5 years from today. Robotaxis operating worldwide, energy storage projects powering cities, and a fleet of affordable next-gen vehicles dominating global EV sales. If the company executes even part of this vision, a stock price north of $2,000 is not out of the question. Owning shares purchased at $380 would look like an incredible bargain. And if Tesla merely maintains its current dominance and grows steadily, you still collected $1,000 for your patience while waiting for a possible entry. This is how smart investors use options, not for wild speculation, but to get paid to wait. Selling a put at a strike price where you'd love to own the stock transforms market volatility into opportunity. It's a disciplined way to enter a position at a discount or generate income while remaining selective. Think about the difference between this and buying shares outright today. At $440, if Tesla drifts sideways for a month, you gain nothing. With a sold put at $380, if the stock stays flat or even rises, you've made $1,000 in just 25 days. That's the kind of strategic edge professionals use every day, and individual investors can use it too. Remember, this is not financial advice. If you found this breakdown valuable and want more high-impact investing strategies, like this video and subscribe to the channel for more.